According to Investors Business Daily, Palantir Technologies has just slid to a fresh 52-week low, and that move is catching the attention of a lot of investors who had tied big expectations to the company's artificial intelligence story. According to Investors Business Daily News, this new low comes after Palantir's stock has already fallen more than 30% this year, in a backdrop where software and AI-related names have been under pressure from shifting expectations about interest rates and the broader tech cycle. Investors Business Daily mentions that this isn't just about Palantir in isolation, it's part of a wider retreat in richly valued software and AI stocks as investors reprice how much they're willing to pay for future growth when borrowing costs stay higher for longer. Let's explore what this means for Palantir's fundamentals, for its valuation, and for investors trying to decide whether this is a warning sign or a potential opportunity. First, some quick context about Palantir. According to Investors Business Daily, Palantir is best known for its data analytics and software platforms that help governments and enterprises integrate massive datasets, run complex models, and increasingly deploy artificial intelligence features into their decision-making. The company has long been associated with defense and intelligence agencies, but over the past several years it has been working hard to grow its commercial business, pitching itself as an AI platform provider for industries like healthcare, manufacturing, finance, and energy. For stock investors, Palantir has often been grouped with high-growth software names, companies that could, in theory, scale rapidly, generate high-margin recurring revenue, and become central infrastructure in the AI era. That vision helped drive a strong run in the stock after it went public, especially during the wave of enthusiasm around generative AI. However, as Investors Business Daily highlights, that enthusiasm often came with lofty valuations and very optimistic assumptions about how quickly AI revenue would materialize. Now we're seeing the other side of that trade. Let's break down the main forces behind the recent weakness, especially the combination of an AI retreat and rising interest rates. According to Investors Business Daily, software stocks in general have been hit as markets adapt to the idea that interest rates may stay elevated longer than previously expected. When interest rates rise or stay high, future cash flows from high-growth companies are discounted more heavily, which mathematically reduces the fair value that investors are willing to pay today for those future earnings. This effect is particularly sharp for companies like Palantir that investors see as having most of their value in long-term growth rather than in near-term profits. At the same time, there has been a cooling off in the AI trade. During the early phase of the generative AI wave, nearly any company that mentioned AI in its earnings calls, investor presentations, or product roadmaps saw a surge of speculative interest. Palantir leaned into this narrative with its artificial intelligence platform, often called AIP, pitching it as an operating system for AI in the enterprise. While there is real substance to these offerings, there is also a gap between early pilots and large-scale, recurring deployments. Markets are now asking harder questions. How quickly will these AI initiatives move from proof of concept to material revenue? How sustainable are these growth rates once the initial hype normalizes? According to Investors Business Daily News, the recent pullback suggests that investors are reassessing those timelines. Instead of paying a premium multiple purely on potential, they're requiring more evidence of durable, high-margin growth. For Palantir, that means investors are watching a few key areas. They're watching the growth of the commercial business versus the government segment, because commercial revenue is often seen as the more scalable and diversified driver of long-term upside. They're watching operating margins, to see if Palantir can continue to improve profitability even as it invests heavily in AI product development and sales. They're watching deal size and customer expansion, especially in the context of the AI platform, to determine whether customers are increasing their spend over time. When a stock hits a 52-week low, it usually reflects some mix of these concerns. Now, from an investor's perspective, there are usually two broad interpretations of a new low in a high-profile growth stock like Palantir. It can be a warning, or it can be an opportunity. Let's look at the warning case first. Why some investors might see this as a sign to stay cautious. According to Investors Business Daily, the broader software sector is under pressure, and Palantir is not immune. In a higher rate environment, companies that rely on long-dated growth stories are inherently more vulnerable. If the macro environment weakens, government and commercial customers may delay or slow digital transformation and AI projects. That does not necessarily mean they cancel them outright, but it may stretch out sales cycles, decrease near-term revenue growth, and limit the company's ability to beat expectations. For momentum-oriented investors who bought Palantir during the AI hype phase, this environment feels very different. Instead of chasing higher highs on each AI announcement, the market is scrutinizing every metric and pushing back whenever growth or profitability does not accelerate fast enough. There is also the risk that competition intensifies. Large cloud providers, enterprise software giants, and specialized AI startups are all targeting pieces of the same value chain that Palantir wants to dominate. If customers decide that generic AI tools from hyperscalers, combined with their own internal teams, are sufficient, then Palantir's differentiated value proposition may be harder to defend at premium pricing. In that scenario, the stock's decline could be signaling that expectations are still too high relative to what Palantir can realistically deliver over the next several years. Now let's look at the opportunity case. For longer-term investors with a multi-year horizon, new lows can sometimes be attractive entry points, if the business fundamentals remain strong and the concerns priced into the stock are more about sentiment than structural deterioration. According to Investors Business Daily News, the stock has dropped over 30% this year. When a name with a solid balance sheet, recurring revenue, and real customer traction sells off that sharply, value-focused and patient growth investors start to pay attention. They ask a different set of questions. They ask whether the current price already reflects a more conservative growth path. They ask whether the core technology moat is intact. They ask whether the management team is executing on a credible roadmap. If the answers to those questions are positive, then a steep decline can provide a margin of safety. With Palantir, the bull case often centers on a few pillars. First, the company's deep entrenchment in mission-critical government and defense work. These contracts tend to be sticky, long duration, and complex, which creates high switching costs for customers. Second, the potential for the AI platform to become a standard layer for enterprises that want to combine their proprietary data with advanced analytics and AI workflows without building everything from scratch. Third, the operating leverage embedded in software. If Palantir can continue to scale revenue while managing costs, incremental margins could improve significantly over time, which supports the argument that the company will eventually generate substantial free cash flow. But an opportunity is not the same as a guarantee. Even if the long-term thesis is intact, investors have to consider execution risks, valuation, and time horizon. Let's talk about valuation dynamics in this environment. When rates are low and optimism is high, markets often emphasize story over numbers. Investors project rapid adoption curves, assume sustained high growth, and are willing to pay very high multiples of sales or earnings. According to Investors Business Daily, what we are seeing now is a shift away from that mode, toward one where investors demand clearer line of sight to profitable growth. For Palantir, that means the market is reassessing how to balance the AI story with actual reported results. If revenue growth decelerates or if margins plateau, even temporarily, a stock that once justified a premium valuation can be re-rated lower. A re-rating is often painful in the near term, but it can reset expectations to a level where the company has a better chance of consistently meeting or beating consensus. In other words, a sell-off can eventually create a healthier setup for long-term holders. From the perspective of risk management, investors in Palantir need to be very clear about their own objectives. Shorter-term traders may focus on technical levels, momentum indicators, and sector flows. For them, a new 52-week low can be a strong negative signal. They may worry about further downside as stop-loss orders trigger, as trend-following strategies continue to sell, and as sector ETFs rebalance. Longer-term investors, in contrast, may look at the same chart and ask whether the underlying business is being mispriced. They will dig into fundamentals instead of just price action. They'll focus on things like the diversity of the customer base, the pace of new product adoption, and the durability of the company's competitive advantage. They're also likely to pay attention to management's capital allocation decisions. Is Palantir using its cash flow wisely, perhaps to invest in R&D, expand go-to-market capabilities, and selectively partner with other players in the AI ecosystem? Or is it excessively diluting shareholders through stock-based compensation without generating commensurate value? Another important angle in this environment is macro sensitivity. According to Investors Business Daily News, rising interest rates are a central driver of the current pressure on software stocks. For Palantir investors, it's useful to think through a few scenarios. If rates stay higher for longer, what does that imply for valuations across high-growth tech? Usually, it supports a more selective and disciplined approach, with investors concentrating capital in the companies that can prove both growth and profitability. If economic growth slows or enters a recessionary phase, what happens to big-ticket digital transformation projects? Government spending on defense and national security can sometimes remain resilient, but commercial budgets may feel more strained. This could result in uneven growth between Palantir's segments. On the other hand, geopolitical risk and security concerns can boost demand for advanced analytics in certain government and defense contexts, which may support that side of the business. This mix of macro and sector-specific factors makes Palantir a stock that is highly sensitive not only to its own execution but also to shifting market narratives. Investors should also consider behavioral dynamics. When a stock falls sharply, investor psychology can swing from greed to fear. Earlier, FOMO, the fear of missing out on AI-driven gains, may have pushed some buyers to chase Palantir at higher prices. Now, fear of further losses may push some holders to exit near lows. This can create overshooting in both directions. For disciplined investors, it's important not to be purely driven by those emotions. Instead, use the volatility to reevaluate the thesis. Ask whether the core reasons you might own Palantir have fundamentally changed. Has the competitive landscape deteriorated significantly in a way that undermines the company's advantage? Has the regulatory environment around data and AI shifted in a way that could restrict Palantir's growth or margins? Has management credibility been damaged by overpromising and underdelivering? If those kinds of negative shifts have occurred, the lower share price may not be enough compensation for the added risk. If, however, the core narrative remains intact and near-term weakness is mainly about macro conditions and sentiment, then a reset like this can sometimes be a chance to build or add to a position over time, aligned with your risk tolerance and time horizon. Let's also talk briefly about how to think about position sizing and risk if you're considering Palantir after this drop. Given the volatility and the dependence on both macro and AI adoption cycles, many investors might treat Palantir as a satellite position rather than a core holding. That means limiting exposure to a level where further downside would not materially harm the overall portfolio. Rather than making an all-or-nothing decision, some investors may choose to scale in gradually, adding in stages on weakness, but only if the fundamental thesis continues to hold up. Others may prefer to wait for clear evidence of a trend reversal, such as a stabilization in price, improving sector sentiment, or stronger than expected earnings results and guidance. Option strategies can also play a role for more advanced investors who are comfortable with derivatives, using tools like covered calls or cash-secured puts to potentially improve entry or exit turns, though these come with their own risks and complexities. According to Investors Business Daily, Palantir's slide to a 52-week low is part of a broader story about how markets are digesting the intersection of artificial intelligence, software valuations, and higher-for-longer interest rates. For investors and enthusiasts following the stock, the key is to separate the long-term potential of AI and data analytics from the short-term swings in sentiment. It's also important to distinguish between a company's narrative and its numbers. AI is clearly a powerful, transformative technology. But not every company associated with AI will deliver extraordinary shareholder returns. The winners will likely be those that convert early technical and commercial wins into durable, scalable, and profitable businesses, while navigating competition and macro headwinds. For Palantir, the coming quarters will be about execution, turning pilots into large deployments, growing the commercial base, sustaining government relationships, improving margins, and demonstrating that its AI platform is not just a buzzword but a sticky, high-value product. As always, this podcast is for informational and educational purposes only and does not constitute financial advice, investment recommendation, or an offer or solicitation to buy or sell any security. Investing involves risk, including the possible loss of principal. Listeners should do their own research, consider their individual financial situation, and, if needed, consult with a qualified financial advisor before making investment decisions. Thanks for listening today. If you found this episode helpful, consider subscribing, following, or sharing it with other investors who are tracking the AI and software space. Until next time, take care and invest thoughtfully.